Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us at the Times Square studio, we have Steve Laipply. He is the head of U.S. iShares fixed income strategy over at BlackRock. We're going to take a look at the four drivers of the fixed income ETF market. It is great to have you with us, Steve. Welcome to Trade Talks.
Thanks for having me, Jill.
All right, and before we look forward, U.S. bond ETFs gathered $200 billion of assets last year. Can you discuss, despite the volatility that we saw in 2022, why you saw those inflows in the bond ETFs?
Yeah, it was quite remarkable because if you think about the shock that we experienced last year, the inflation and then the subsequent yield shock driven by the hawkish Fed, just a repricing of the market in general, it was remarkable. And I think a few things were at play. I think that for investors, despite the rough ride in the bond market on the way up, it was the first time in many, many years that you were able to get yield in the market. So, you know, right now the 10 years at around 3.5%, the 2 years over 4%. If you think about the way those yields looked at a low, I think the 10-year during 2020, during the COVID volatility was, down around 50 basis points. So if you think about this opportunity, investors decided that it may be time to go back into bonds. Go ahead.
So how did you see investors implement their bond ETFs in their portfolios for 2022?
Yeah, and so I think because of this repricing in yields, investors were able to actually hit the same yield targets they were reaching for before, but really dial down the risk. And so if you think about, prior to this repricing, people were in less liquid fixed income, they were in alternatives, obviously equities. Now, if you look at the same portfolio, you can invest in treasuries, as an example, and still get very good yields. So we looked at one portfolio that was multi-asset equities and fixed income. 7% yield target in 2017 would have been around 9% of risk, and now it's down to like 6% because of that. So you see investors implementing fixed income ETFs as a way to really get precise in their portfolios. They're diversified, they're liquid, they're efficient. You can really tailor your risk profile using fixed income ETFs, whether it's in a standalone fixed income portfolio or multi-asset. We also see people pairing index fixed income ETFs with active funds as an example as well. So that's been a very popular thing. Last thing I would say, institutional investors are also becoming very large users of fixed income ETFs. So your active bond manager, 9 out of 10 of the largest asset managers now use fixed income ETFs as part of their active strategy for tactical tilts, for liquidity sleeves to reduce costs in the portfolio. So it's been fascinating to watch the speed of adoption. I think 2020 really kicked that off. Last year kicked it up a notch further.
Yeah, well, of course, being in the ETF wrapper, it makes it more manageable for institutions and, of course, for individual investors. So what's your outlook when you think about bond ETFs moving forward?
I think we are extremely positive on bond ETFs. So we predicted that by 2024, we would be at $2 trillion. We're almost there, and that's global. We believe by 2030, we'll be at $5 trillion in bond ETFs. Now, right now, we're only 2% of the entire bond market. So there's a lot of room to run. So if we think about the drivers of what's propelling this acceleration in bond ETF usage, we identify four. We look at what we call evolved 60-40 portfolios, which is what I just described, getting more precise with your exposure, getting more diversified and efficient, and then blending that potentially with active exposures as well. We look at something we call modernization of the bond market, right? So this is a really big theme. These products have literally transformed the over-the-counter bond market. It's not quite the equity market, but it's becoming increasingly electronic and digitized because of bond ETFs. They're driving, and I think if you go back probably a decade ago, there were fears that bond ETFs would create volatility and disruption in the bond market. They've done the opposite. They've added transparency. They have created sponsorship for bonds that may not trade as much without them. And so this whole ecosystem came about. And then we look also at, product innovation, right? Just this idea that, investors are now able to get exposures that they really weren't able to get before, more precise areas of return. So as one example, we think about our AAA CLO fund that we just launched, right? So you're able to create and tailor more and more exposures. And then I did mention, this ongoing institutional adoption, which we think is only going to grow over time. So all of those things combined, we think is really going to keep propelling this growth forward.
Yeah, it's so interesting. You would think, wow, the ETF market is so big, trillions of dollars assets under management. But to your point, innovation, it still sounds really young, and there is more room to grow as these markets evolve.
Yeah, there really is, and I think what you're going to see out of providers is just this idea of really starting to tailor what that risk looks like. So investors, do use big, broad, liquid funds, but they're increasingly realizing the power of getting more granular in their portfolios and getting more precise. And so that's where our heads are right now in the innovation space, really trying to understand where that's going.
All right, Steve, we appreciate the insight. Thanks for joining us on Trade Talks. And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.